All right, AI has been a huge topic of conversation over the last few months, and it's just going to become more and more of a topic of conversation in the stock market as we move through the next 6 months to finish this year, next year, and beyond. As we look forward, we're definitely going to see some big winners, but we're also going to see some big losers. So you could either be on the side of the trade that makes you a ton of money, or you could be on the side of the trade where you lose all your money. Of course, no one wants to be on the side of the trade where they lose all their money. So that's why I'm making this video. There's one AI stock that has so much hype right now that I think needs to be sold ASAP. But before we get into that, welcome. If you're here for the first time, I'm Austin. I'm a co-owner of cloudmusicsuite.com, and of course, I'm a stock market investor. And I am not a shareholder of this stock that we're talking about today. The channel's sitting at like 210 subscribers right now. If you're one of those 210 people, thank you so much. It means the world to me. If you're watching this video and you end up liking it as you watch through, go ahead and click that like button. As I thank you for doing that, here's a picture of both my beautiful cats, Millie and Luna. Never thought I'd be a cat dad, but now I've got 2 of them. All right, now that we got that out of the way, let's go ahead and get into today's video. There's one AI stock in the stock market that has been on an absolute tear over the last few months. And I believe that there's some stocks that have AI in their name or they talk about AI that are absolute baloney. They're not actually companies that are going to benefit from AI. They're just trying to pile onto the hype. And then there are a few companies, which I made a video about a few days ago, check that out if you haven't seen it, about some stocks that are actually going to benefit. Their revenues are going to go up in a massive way as AI becomes more of a conversation. And that's going to lead to the bottom line, which means their earnings are going to go up in a massive way. And what drives stock prices? In the long term, earnings drive stock prices. In the short term, it could be some news or some hype or some excitement around a new industry. But in the long term, it's always going to be earnings that move a stock price. So this stock that we're talking about here today does not have any of those and is not going to have any of those for a very long time. So this stock here is C3AI, and the ticker on this is AI. Just to kind of put it in perspective on how hyped this stock has been, it has gone on an absolute ridiculous tear. So around January of this year, it was at 11 bucks a share, a little bit less than 11 bucks a share. And now today, as of recording this video, we're sitting at like $37 a share. $37 a share. That's almost a 4x on your money. But what's moving the stock price? Are great earnings calls moving the stock price? Are great revenue numbers moving the stock price? What's moving the stock price in the positive direction? Unfortunately, for shareholders of this company, it's not revenue increasing and it's not earnings increasing and it's not free cash flow getting in a better spot. This company is just riding the hype. There are companies that are not just riding the hype. One of those companies that I think would be a great alternative to this would be Palantir, but we'll talk about that here in a little bit. A little bit of a shady history with C3AI that I'm not going to dive all the way into, but when this company was first founded, like right around financial crisis time, 2008, 2009, this company was just called C3. And the C stood for carbon, and then the 3 stood for measure, mitigate, and monetize. So what they were trying to do at that time, as the same company they are today, was to try to help corporations lower their carbon footprint. That was their whole thing. And then after a little while, that didn't work out so well for them. So they changed their name to C3 IoT. IoT is Internet of Things. And then after that, they changed their name to C3 Energy. And now they went public with the name C3AI. If that doesn't say fishy to you, I don't know what does. If I'm going from hype cycle to hype cycle, which it seems like that's what they did, carbon capture, carbon footprint, crap. IoT, Internet of Things, crap. Energy, talking about whatever the specific hype was around energy, maybe solar was the hype at the time that they changed that name, maybe hydrogen fuel cells were the hype at the time why they changed that name. Regardless, AI now, this company went public in 2020, 2021, 22, 23, and now they're finally hitting that, oh my God, everyone loves AI. And since they have the ticker AI, people assume, because they don't look into the company at all, they assume that, okay, this company is just a leader in the AI space. That's really not true at all. I've heard that the software this company makes is pretty much a joke as it relates to the AI space. There are way less hyped companies that make far better products at a lower price point. So it's like, what are we doing? I don't understand. But that's enough opinionated hate. Let's talk about some factual hate. When I look at valuation measures, this company's at a $4.13 billion market cap, and then the enterprise value is actually lower than the market cap, which is a great thing. So they have $3.36 billion. So that's looking pretty good. And then when we look to the price to sales, A 15 price to sales is high, but it's really not disgusting as it relates to other software companies. So when we compare it to software companies, a 15 price to sales is really not all that disgusting. And then price to book sitting at 4.46 right now. That's also not terrible. But once we dig a little deeper, we start to see the huge problem with this company C3 AI. And that is that they are a serial, absolute disgusting cash burner. And what I mean is their total revenue right now on a trailing 12-month basis, 266 million. Okay, for a market cap of 4 billion, that's really not much at all, but we'll leave that to the side for now. Cost of revenue, 78 million. That looks great. When we look at the total revenue, 266.7, and then the cost of revenue, 78.7, that looks attractive if I just look at that and I stopped right there. But we got to keep moving. So what that means is that gross profit number, it actually looks really good, but we got to keep moving past that. Operating expense, oh my God, on a trailing 12-month basis, operating expense, just selling general administrative, SG&A they call it, the SG&A, selling general and administrative cost, $254 million. That's almost equal to their total revenue. That doesn't include cost of revenue, that's just SG&A, almost eclipsing their total revenue just in that category all by itself. And then you look at R&D. R&D costs $207 million. So you take that $207 million, and then you take the SG&A $254 million, and you get a total operating expense of a ridiculous $461 million on a trailing 12-month basis. They're almost taking a net loss, which is equal to the downside of the total amount of revenue that this company is bringing in. What is the path forward to profitability when you're a cash burner that bad, that disgusting? Look, the operating income, oh, it's even worse than I thought. Operating income is more of a loss than total revenue. So this net margin has to be like negative 102%. That's ridiculous. Yeah, so here it is. Profit margin is negative 100.77%. Wow, that's so unbelievably bad. It's hard to look at. Okay, so you have to look into the numbers with these companies. You can't just say, oh, its ticker is AI. Oh, it talks about AI. It's going to benefit in a massive way. There's really no path forward, in my opinion, for this company as it relates to profitability. There's no path forward. If you can see a path forward, you let me know, you detail a plan, you let me know how this company's gonna get to profitability, but I just don't see it happening, okay? Add to the fact that the total revenue number they have, about 40% of that is from one single client. And I shouldn't say it's a client, it's more of a joint venture, joint partnership filed with the SEC, and that's with Baker Hughes. So Baker Hughes, oil and gas company. I don't want that much exposure to oil and gas, period. Doesn't matter what company it is. If any company has that much exposure to oil and gas, I'm probably not gonna wanna be in that for a long-term play. If you're playing this as a swing trade, go for it. If you're gonna short the stock, go for it. That's not personally what I do. I look for long-term opportunities that I can put my money in for years and years and years. C3 AI is not one of those companies I can put my money in for years and years and years. Anyway, moving on. Not everything is as disgusting as their income statement. Their balance sheet actually looks like it's in a very respectable spot. How long that lasts is the question. If I'm a serial cash burner, how good can I keep a pristine balance sheet? And I wouldn't say their balance sheet's pristine, but it's very respectable. When we look at total assets, they have 1.1 billion in total assets. Current assets, 888 million. That 888 million current asset to market cap, that's about a 5x, okay? From the current assets to market cap, that's very respectable. And 284 million of that is cash, and then 446 of that is short-term investments. I would assume those short-term investments are T-bills. A lot of companies, as treasury yields rise, they're gonna put their money in those treasury yields so they can get some very low risk return on that money while they let it sit there. And it's very liquid, they could sell it at any moment, and then it could be used for continuing operations or whatever they need to use in their business. So very liquid, they put their money in T-bills, that's my guess. Total liabilities, 173 million. So they have enough cash to pay off all of their liabilities today if they wanted to do that right now. And then something else to note is that they have no short-term debt whatsoever at all. All they have is pension requirements and some deferred revenue. So that's extremely respectable on the balance sheet side. But the question is, when you have more of a net loss than all of the revenue that your company had combined throughout the whole year, how are you going to keep the balance sheet in a good spot? if you don't dilute shareholder equity, which this company is a serial diluter, having increased the amount of shares outstanding since they went public by about 20%. We don't like to see that. We want to see your shares outstanding decreasing as time goes on. So needless to say, this is a stock that I'm staying away from. I will not be investing in C3 AI. If you're interested in investing in C3 AI for the long term, my advice to you would be wait until you see some sort of path forward for profitability. They need to have a net profit because earnings, profits are what move companies in the long term. Revenue only does so much. Revenue needs to hit the bottom line in order for the stock price to get respected in the long term. If they're just riding the hype and that's why the stock price is going up, that's not sustainable. So be very careful if you're going to open a C3 AI position as an investment. If you're going to trade, whatever, do your thing. I don't know anything about that. I don't do anything with that. I'm not a trader. But if you're going to invest, please be very careful and understand that this company loses so much money that I do not see a path forward for them to stop losing that amount of money. A company that I think is a much better investment that I personally own is Palantir. And this company also has gone on a ridiculous run since the start of the year. It's over doubled up in the last very small number of trading days. Somewhere around 30 trading days, it's more than doubled up. Palantir is also riding a little bit of that AI hype, but they also have real numbers behind them. They've been free cash flow positive for a very long time. I have tons of videos on this channel about Palantir. They've also hit EPS, GAAP profit, 2 quarters in a row, and they guided for the rest of 2023 to be profitable. So that would be 5 in a row by the time we get to the end of 2023. And then that's going to be an S&P 500 inclusion conversation. Does that mean they're definitely going to be in the S&P 500? No, but I can see them being in the conversations for it as we move through the next few quarters of GAAP profit after GAAP profit after GAAP profit. This company is not a money loser, they're a money maker, and they're just going to expand that margin over time as the revenue increases because they're cost of revenue is going to increase at a slower clip than their revenue does. And that means that money is going to hit the bottom line, and that's going to be profits. And remember, profits are what move stocks in the long term. So check out Palantir. I am a holder of Palantir. I haven't bought a Palantir share since it's went on that crazy run. I've just been holding. I've just been letting it ride. It's been a fun time. If you're a fellow Palantir shareholder, congratulations. If you own C3 AI shares, please just be very careful and understand they're a serial money loser and they're a serial share diluter. So just be careful. I know the balance sheet looks like it's in a great spot, but how long can they sustain that without continuing to dilute shareholder equity? Just some things to think about. I'm staying away from C3 AI. Let me know what you're doing in the comments below. I'd love to hear about it. Let's get some debate going on down there. Thank you so much and have a good one.